How would things change for you to be completely debt-free, including your mortgage? That may be a question people think about from time to time, but it's probably more along the lines of dreaming because that seems like such a real stretch for most people. But what if there were a way for financially responsible households to be totally debt-free, including their mortgage, in 5 to 7 years, save $100,000 or more in interest, turn their debt payments into an asset that builds tax-free retirement income, and put important protections in place for their loved ones? Well, it's very much a reality and exactly what we're helping people do every day. But let's take on what I think is one of the most fundamental aspects of this program, and let's kick that off with a scenario and a question. So here's the scenario. We have two home loans, Loan A and Loan B. For round numbers, let's say Loan A has an interest rate of 4% and Loan B has an interest rate of 8%. Is it possible that Loan B, with twice the interest rate, could be paid off in a fraction of the time as Loan A and save over $100,000 in interest expense? As you might imagine, the answer is a resounding yes, but this flies in the face of everything we think we know about the topic because what does everyone focus on? The interest rate, right? But getting back to that indoctrination I mentioned last time, are we being led to understand that that's the only thing that matters, but we're actually missing a key piece of the puzzle? Well, I think that's absolutely the case. But how is it that a loan with twice the interest rate can be much more beneficial for the borrower? The reason is that in the example I used, Loan A with a lower interest rate is an amortizing loan, and Loan B with the higher interest rate is a simple interest loan. With an amortizing loan, more than 50% of interest is paid in the first 10 years, and it's only in the final 10 years of a traditional 30-year mortgage that principal payments dominate. But here's an interesting twist. Guess what most people do around 7 years into that kind of loan? They either buy another house or refinance, which starts the process all over again. And here's a little factoid most of us don't want to think too much about. Typically, at an interest rate of 4% or up, a borrower will pay in interest the equivalent amount of the purchase price of the home. That's right, we're effectively buying two houses and giving one to the bank. So what is it about Loan B that makes it so special? As I mentioned, it's a simple interest loan, so there is no amortization schedule, and interest paid is only dependent upon the outstanding balance of the loan. When we replace that amortizing loan with a simple interest loan, we fundamentally change how it operates, and we reduce our interest expense dramatically. So we've come to understand that something we pay an excessive amount of attention to, interest rate, is actually not the most important factor in how good a home loan is. So see you next time as we continue to explore the power of accelerated debt elimination. Until then, be well.